Hey, what is up, everybody? I am Matt Drew, and I'm the host of Go Big Live Real Estate Investors Podcast. I have a special edition, part two, with Mr. Tom Grzebinski, Senior Director at Gantry Commercial Mortgage. By the way, you're going to want to tune into the end of this because we're actually going to be going into the technical type of details you're going to want to be empowered with when you're going through financing or refinancing commercial property. Because towards the end, we're going to go into what makes a loan go sideways and how you can work with your commercial broker to get it back on track. But also why it goes sideways so you can avoid it going sideways to begin with. So I'm really excited to get to that point there, but we're going to go into a lot of more technical types of details today in terms of actual type of things that you're going to want to know when you navigate the commercial lending space. So welcome back to the show, Tom. I appreciate it.
Well, we had so much fun the first time. Let's keep it going. Thanks for the invite, man. I appreciate it.
Absolutely. Yeah. And if you're tuning in right now and you missed the part one, I'm going to have a link directly to that in the description below. And also towards the end of this, you can get tuned into that. So without further ado, I'm going to jump right into it. Tom, how has the real estate landscaping changed in upstate New York over the past 5 to 10 years?
Matt, in upstate New York, I'm going to focus really Buffalo, Rochester, Syracuse, Albany, kind of that 90 corridor. The way that it's really changed is historically, if you were a Rochester borrower or Rochester developer, you stayed in Rochester. You didn't spread yourself out to Buffalo, Syracuse, Albany, etc. Over the last 10 years, there's been this crossbreeding within those markets. So the Buffalo folks are going to Rochester, Syracuse. The Rochester folks are going to Albany and Buffalo. The Albany folks are coming over to Buffalo. So you're seeing a lot more cross-pollination. And then it gets compounded by the values of upstate New York real estate are far more attractive than the returns that you'd get from the larger metros, the top 50 MSAs. So we're seeing Florida developers and New York City developers and New Jersey developers coming into upstate New York because where a cap rate down there is 2 to 3%, cap rate up here could be somewhere between 5, 6, 7%. And so the returns get a lot more push. We don't get the large increases and appreciation of rent every year as some of those gateway markets do, but our markets are steady and predictable, and there's nothing sexy about upstate New York, and that's okay. You know what you get from year to year. So that's one part of it. The other side of it is the lenders. Historically, lenders in Rochester would stay in Rochester, and if they got to Batavia, they stopped. And if they got to Del Lago, they stopped. Now they're really opening up the wings, and they're taking more risk and going into other parts of the state. So you can grow a relationship with a Canadian national bank or some regional bank and push out to the Buffaloes and the Syracuses and the Albanys. So there's a lot more geographic growth within the banks. Furthermore, one more thing about the banks is we're seeing a lot more national lenders coming into the market. So you think of your lending sources, who you're going to go for your capital, and you have that list of 5 local banks. Well, there's another 10 local banks that are local because they're in the market, but they're not necessarily based. So we'll bring in a Pennsylvania bank or a Connecticut bank or a New Jersey bank. They're all active in upstate New York. You don't even realize because they have brick and mortar location. So it's becoming a lot more diverse.
Okay, so more diverse. There's also, you said something pretty interesting there that national lenders are taking an interest into our Rust Belt communities of Rochester, Syracuse, and Buffalo. Is that in response to maybe the cap rate compression that we've had in terms of like larger MSAs, and maybe there's a chase for yield? Like, why are they having more of a comfort factor with our little Rust Belt communities in Western New York?
Thirdly, it's the yield. They can go after the projects in Miami or Houston or LA and get curb stomped, and it's a flight to the bottom as far as what the interest rate should be, the spread should be. Or in upstate, they could get a premium in the yield and put their money out in a safe market that doesn't have those ups and downs and be able to achieve a better return.
Yeah. And then in terms of national lenders, I know that a lot of investors that are viewing this right now have strongly been anchored and married to community banks.
Yeah.
What types of options get open, or what have you been seeing out there that in terms of menus of products that national lenders can bring to the table that community banks typically can't or won't bring?
The biggest things that I could tell about national lenders versus the regionals is the nationals would prefer to do longer term fixed rates. And the nationals are less concerned about personal recourse. And the nationals don't generally require a deposit relationship. We'll talk a little bit more about that in a minute. I think we're going to have some questions about that in a little while. So it's just a different type of relationship, more transactional of a relationship as opposed to relational relationship with your local bank.
So that being said, I mean, national lenders, community banks, regional banks, life insurance companies, whatever, what types of properties do lenders find to be attractive and why?
The term is bricks and sticks and $1 million and higher. That's the start point. But then there is a hierarchy of that. So anything from multifamily to self-storage to retail, industrial, hospitality, office, parking lots, anything that's really revenue generating and $1 million or higher. So that's really what we're calling a commercial real estate deal. There is a lender for each one of those property types. Some of the lenders really do focus in on just multifamily, such as Fannie Mae and Freddie Mac. They're very focused on that multifamily aspect. There's a very little amount of commercial space outside of the multifamily that they'll accept. Some lenders do like just retail. Single tenant retail is a perfect example. Single tenant credit retails are a great example. The Starbucks and the McDonald's of the world or 7-Elevens of the world. So there are lenders for every bucket of opportunity.
So let's talk about the elephant in the room here from an asset class standpoint. Office. We're largely exposed to office. I mean, we made a big push into office post-COVID because we kind of saw the investment community redline that as a asset class, and the banks hadn't quite redlined it at that point in time. But I mean, what are you seeing out there in the transaction space in terms of office, appetite for office product, and that type of stuff?
For office specifically, there is an appetite to do financing for office. It's much less of an aggressive underwriting. The popular office products, the most attractive office products are amenity driven. So you'll have a gym in there or some kind of cafeteria in there or some kind of workout. Yeah, definitely the gym, the workout area in there. Maybe you put a little dog park in there or something like that, a walkability portion of it. The reality is everyone hasn't come back to the office. And these existing tenants, they have to figure out, what do they want their office to look like? Do they want everyone to be in the cattle farm of call center, or do they want everyone to have individual offices, et cetera? There's still going to be a lot of discovery over the next several years. But lenders do have a appetite for office. It's just a different underwriting when it comes to what is attractive within that market right now.
So tell us about kind of how that's changed. Like, give us some metrics on office specifically, because I'm interested in learning more about this, because I still think like we're contrarian investors, we're opportunistic investors that are based and focused in the greater Rochester, New York market. What types of appetites in terms of like, if you were to go with the metrics in terms of like occupancy percentages, types of like lease terms, that type of thing, in terms of like what is working and what is getting very hard to finance from an office asset class perspective?
For sure, the Class A office and the Class B office are still going to be viable. The Class C office should all be converted at this point into some sort of a mixed-use property. The metrics, I would say that the metrics right now are real actual vacancy or the market vacancy, whichever is greater. And market vacancy right now is approximately 15%, but it also varies between urban and suburban. So we would use a tool called CoStar, and we could actually see what the submarket is for that space. But you want to use, from an underwriting perspective, the greater of actual or market. From a tenant mix perspective, either long-term, being 10 years plus of a credit tenant for a single tenant deal, the preference is either that or to have a very granular rent roll. A lot of the lenders right now would prefer to have 20 tenants doing 3 to 5 year leases than 2 tenants doing 7-year lease, as an example. The reality is that to flip office space is very expensive. And when we have these large floor plates with single tenants, backfilling that space is a real challenge. Trying to replicate the income of the rent number from 5 years ago is a challenge because there is so much available space right now, either sublease or regular space. When you're looking at a potential office building, the more granular the rent roll, the better, in my opinion, and the lender's opinion, frankly. From a metrics perspective, a 135 debt service coverage on a 20 or a 25-year amortization is what you should expect. And we have to have strong, deep pockets because you have to understand what's going to happen when that space rolls over. How is that space going to get turned over? It's costing anywhere from $50 to $150 a square foot to backfill space.
What you said interesting, it was pretty interesting there, was actual vacancy rate versus market vacancy rate. So based upon what you're telling me there is that you could be buying an office building that has 100% occupancy, but what you're telling me is that, and correct me if I'm wrong, is that the underwriting will apply, let's say, a 15% vacancy factor if that's what the market vacancy rate is. Is that correct?
That's exactly correct. It's going to be the more conservative of those two numbers. And as the borrower, you have to just recognize that typically will mean more cash in at the beginning of the project, but more cash flow, assuming that you're able to maintain that 100% occupancy. You'll just get your money back through cash flow. But the lenders are really leaning heavily on the appraisers. The appraisers are really leaning heavily on market information. If we have to be honest here with office, whatever the vacancy number is, it's probably higher than what is being disclosed because intuitively we think that there's more subleasing that would be available. If somebody came to a landlord and said, "Hey, do you have any space?" The tenant would probably give up some space at this point in most cases. So even if it is a 15% vacancy, the real number is probably closer to 20.
We've been making offers out there on office properties, and we've been making them based upon what the current occupancy is on it. And we've been getting responses back, I think, in terms of like we've still had a bid-ask spread with office owners and that sort of thing. And they're like, well, you're expecting us to give our vacant space away for free is what your offer is indicating to us. It's like, well, we're not getting credit for that space. We're buying it for income generating purposes. And also this space is tired. It's a C-class office space that's got a bunch of closed offices, a bullpen. This is not the way the office is. So we're going to have to put in $100, $150 a square foot on tenant buildouts on, let's say, a 5-year or 7-year lease deal from a tenant coming in that, they may not be in there at the end of that point in time. So that investment might be a sunk cost. And it's not common in the office product space for tenants to go in and be like, hey, I'll take this as is. I'll find an architect. I'll find a general contractor. We're talking about, like, let's say, a CPA firm, because a CPA is not a general contractor, is not a developer. So they want to actually walk into a turnkey office space and just move their equipment in there. It's definitely, I think that we're getting good deals in office space out there, but I think that there's still a lot of reality that hasn't set in with owners of those properties.
And yeah, a $20 a square foot rent on a space that you've invested $100 a square foot to build out for 5 years or just to break even. And that's not a really attractive return in that instant. And to get a $20 a square foot rent is pretty good in this market for upstate New York. The real challenge for office space is really a national challenge. It's not as much as an upstate New York challenge. The large buildings in the large gateway cities, those market rents have really compressed, and the valuations of those office buildings have really dropped because of that. You have the increase in interest rates, which is intuitively supposed to make your cap rate, the valuation, less attractive, and you have a reduction in interest rent rates. So you have an increase in interest rates, therefore the valuations are reducing. And at the same time, you have a reduction in your rental rate, therefore the value is reducing. And so when you have large cities like the New York cities and the Miamis and those types of cities, those are the big challenges, because those loans on those large office buildings are going to be coming up for maturity or have started to come up for maturity, and there's no home, they're all underwater. So you either throw the keys across the table or you broke a check and you right-size your loan. We can talk more about that troubled loans in a couple of minutes.
One more follow-up question before we move on. You referenced in office, you're generally seeing a debt service coverage ratio requirement of 1.35. What other types of DSCR covenant changes have you seen out there in this market where you've shifted and maybe surprising to certain asset classes that you can speak of?
Most loans are not loan-to-value constrained or loan-to-cost constrained. Almost every loan right now is a debt service constrained. Multifamily and self-storage right now are 1.25 times debt service coverage. Multifamily on a 30-year amortization. All other asset types would be on a 25-year amortization in general. So 1.2 to 1.25 is where you should be underwriting to. Now the question becomes, what's the interest rate? And that's like throwing a dart at this point, because there's a lot of price discovery happening on the regional bank level. Some regional banks are just totally shut down for commercial real estate. The ones that aren't shut down, do you have an attraction to it? They're seeing it as, we'll do the deal if we get the right yield for it. So a local bank deal could be a 5-year deal and it's a 7.5% interest rate. A life insurance company deal or a national lender type of deal is basing it off of the 10-year treasury. And it's typically 200 basis points over the 10-year treasury, which is today about 4.5% for an all-in rate of 6.5%. So you'll get a little more dollars in that situation because the debt service constraints the constraint, but your interest rate lower, so you can get a couple of extra dollars there.
So what type of asset classes are you seeing out there, or types of deals you're seeing where the DSCR, debt service coverage ratio, is above 1.2, 1.25?
It would really typically be either in a refinancing scenario where there was already there was already equity in the deal, or on an acquisition where the seller is selling it and doing a 1031, putting it into a different asset. It's all about equity coming into deals for the acquisition right now. So the constraints are typically 75 or 80% loan to cost on a purchase. That's kind of what we've all been brainwashed into over the last decade. The reality is, on a 1.25 debt service coverage or a 1.35 debt service coverage, depending on what type of asset you have, you're not going to even get to 70% loan to cost / loan to value.
Yeah, because of the interest rate.
Correct.
So next question. What are some of the benchmark underwriting metrics that lenders want the project to achieve?
I think we kind of covered those with the 75 to 80% loan to cost / loan to value and the debt service coverage. Those are the numbers. Right now, you're not going to get a lender that really look hard at a deal that has a ton of story to it right now. Everyone's trying to stay a little more vanilla and kind of figure out what's in the portfolio and how they can get stuff out of the portfolio and clean it up a little bit. So the cleaner the deal, the easier that financing would be. Don't go stretching at this point in the cycle.
So I know that was kind of like a reiteration of a prior question or answer that you did, but I guess some further on that is what you're seeing is that deals with hair on them are kind of not getting as easy across the finish line financing wise.
They're not. They are getting done, but again, with more equity or more creative financing, whether that's a C-PACE portion or some kind of a government enhancement from SBA or USDA, something like that. Or it's a harder money or a debt fund type of deal where you have double digit interest costs, interest rates, while you prove yourself in turning the property over or completing your plan. You got to pay to play in that case.
Okay. Tom, next question is, and you may have answered some of the elements of this, but give me anything you haven't said so far, but what property types do lenders tend to underwrite more conservatively and why?
The more conservative underwriting is typically for things that have short-term leases, things that are coming up with expirations on the lease and something has to happen. You just assume that the rent's going to go down instead of up for anything except for multifamily. Even industrial at this point is tapered and starting to come down.
Yeah.
So anything with short-term leases or anything what I'd call high turnover would be the other. On the multifamily, every lender is really taking a little more focus right now on the historical collections. And we're seeing, especially in a Fannie and a Freddie loan, an agency loan, they're pulling actual deposits to show and prove the collections out for the last couple months prior to closing. So keep good records. If you're a buyer or a seller or somebody that's a candidate for refinancing, keep good records for that year going into your refinancing activity.
So that's interesting about multifamily and collections, because sometimes we've acquired multifamily assets that were just mismanaged, run by mom and pops. Wife was the property manager who's friends with all the tenants, and the collections have been a little bit loosey-goosey and that sort of thing. Let's forget about the record keeping on that. But an operator like myself coming in our company, we acquire assets like this that have been mismanaged. And so what you're saying is that there might be some issues, especially if we're using agency debt. If we buy a mom and pop deal and let's say the collections are a little bit sporadic or are showing an economic vacancy that might be higher than the actual physical occupancy. So tell me about how those deals are getting done. Is it just a simple thing as like, well, you're going to have to consider putting more equity in the deal if you're buying a property that's had some spotty collection issues? Or tell me about that.
If you're going from a mom and pop operation to a professionally managed multifamily project, Fannie Mae would be a path for you. And the story is the fact that you have street cred as the professional management company. And you can show a history of doing this over and over again. The reality is, if it's mom and pop owned, probably not run efficiently, and they probably missed rent bump along the way also. You have two choices at that point. You can either go to the Fannie Mae permanent loan market and do a 7-year or 5, a 7, a 10-year deal with a permanent lender, as we like to call them. Or you could park that thing on a local bank deal, finish up your plan, your management plan, your execution, so that property stabilizes. You push the rents, you put the lipstick on, you manage the property the right way, you get the expense loader because you have some economies of scale, and then you put it in the permanent market 2 years from now.
Yeah, because there's actually there's a deal that we talked about, the one deal that I was having trouble with. There was a mixed use multifamily deal that is when I actually first started talking to you. We grabbed lunch to talk about it, and so I ended up bringing that it was a property that was a heavy value add. It was going to take about 1.5 to 2 years to get stabilized and show consistent rent collections and get a whole new tenant profile through there. And is one of those deals I'm going to be bringing to you guys in the near future. Let's talk about that a little bit and kind of use this like a little mini case study. So that's a 28 unit mixed use deal. There's 2 4-family properties that are actually right adjacent to each other. And then there's a larger building that's like got 22 apartments and 2 commercial storefronts. Would that package be applicable to a Fannie Freddie deal, even though it has some retail component to it? Or is Fannie Freddie sort of like pure play? If there's anything besides residential in this, like we don't touch it.
Fannie and Freddie does have an appetite for some partial commercial. Fannie has a 20 to 25% of economic income aspect of it. Freddie Mac will go up to 30%. And if it's more than that, that's fine. You're only going to get credit for up to that 20, 25, or 30% on the income side. So if it's a 50-50, you're going to get cut pretty hard on your income side. If I had to guess, it probably would make it prohibitive to go to a Fannie and Freddie. But you could do a life insurance company deal. You could do a Wall Street deal in that case. There's other avenues besides Fannie and Freddie. The Wall Street, we don't do a lot of Wall Street deals. Just in general, the market upstate New York is not a Wall Street CMBS type of market. But right now, Wall Street's pricing out everything based on 5-year deals, and it's all interest only right now. So that is one path. If you need max dollars, you could do a Wall Street deal. Typically, those start at $2 million or higher. Those are a little bit higher on the spectrum as far as loan size. But it is an option. It gives you as much dollars as possible. They'll run it down to a 110 debt service coverage, interest only. And I don't know how long that's going to last, but right now that's what the market's accepting.
Yeah. So like, let's talk about today's rates right now. So if I was to refinance that deal with a Fannie Freddie, because I do believe the economic contribution of those retail spaces are definitely below 20%. What what type of pricing will it be looking at from an interest rate standpoint?
Sure. For Fannie and Freddie on a small balance loan that's anything less than $7.5 million, the 10-year money, right now the 10-year money is more attractive than the 7 or the 5. We have an inverted yield curve. So the 5-year treasury is higher than the 10-year treasury right now.
Wow.
But usually that's a sign of potential recession. In this case, that structure has been like that for over 12 months. So either the shoe's going to drop or this is the norm for a little while. The 10-year financing would be the most attractive as far as pricing. You'd get a 10-year deal with 2 to 3 years of interest only, and then a 30-year amortization thereafter. Your interest rate on a small balance loan program is just around 7% today. So about 6.8 to 7.25, depending on the size of the deal. And if there was a larger size deal, if there was not a small balance loan program, so it should be like a $7.5 million or larger, that interest rate, a 180 over the 10-year treasury. So that's all in like 6.3% right now for a larger size Fannie Mae loan.
Yeah, that's why I think that I'm always preaching that I'm always saying like bigger is better, but there's also big is sometimes too big. And there's this element of the market where there's more market inefficiencies for real estate investors that are kind of flying below the radar of that, like, let's say $7 million deal. Cause that's going to be like, okay, we can, these more institutional, bigger, more established players are gonna be like, well, we're only going to do deals that are in excess of this amount because we get more attractive debt financing. But in the smaller deal space, I think that it presents more opportunities for those investors that are looking to swim upstream into those types of deals because like those aren't looked at or touched by those as much. So that's pretty cool. So what are some of the hot buttons that lenders are currently focused on? Hot button issues.
The local banks, I want to focus on the local banks for this, Matt, because the majority of our borrowers in this market are local bank driven. Local banks right now, it's all about deposit relationships. Every deal that comes in, they want to make sure that they're getting some aspect of deposits when they're putting money out the door for commercial real estate. And they're more focused than ever at the local bank level on true relationship, what they call share of the wallet. They want the security deposit if possible. They want you to be able to use their clearing. They want to do the payroll. They want to use their credit card. They're really trying to push real relationships. So those are the hot buttons. Is this a one-off deal or is this a relationship potential? Our business isn't looking for one-off deals. It takes a lot to get a client. So once we have the client, we want to keep growing the client. We're generally not one-off type of brokers, but that's the biggest thing, the remote capture, anything else that they can get from the local banks. The hot buttons for all commercial real estate lenders right now is really experience or management experience. If this is your first foray into multifamily, or as an example, the lender is probably going to ask you to hire a professional management company. And it doesn't have to be forever. Get a couple of years, get your sea legs under understand the business a little bit, but use and leverage somebody that knows how to do that and can help get you through that part of the acquisition. So those are the real hot ones.
So management experience, let's talk about that a little bit. Like, is this just based, if I own a 2-family, am I experienced in multifamily, or are they looking for something different?
There's a couple ways I can answer this, Matt. One is if you have a 2-family and you're buying a 48 unit, probably a 2-family is not going to be enough management experience. The longevity of management, there are actual metrics of Fannie Mae. I'm just going to use that as an example. We've talked a lot about Fannie Mae today for whatever reason, but that's fine. Great avenue for the multifamily. Fannie Mae has very specific requirements for any owner, and that is you would have to have either 5 years of 5-unit or a current portfolio of. There's just metrics, and I could share that with you. Maybe we could put that as a hyperlink of what those requirements are. But they have a 2-unit going to buy a 48 unit isn't going to be enough for sure. There's other metrics that are liquidity and net worth requirements for Fannie Mae. And again, maybe we could put those as a follow-up to this, as something that we could add to it. But the reality is it's net worth has to be at least the loan size, and your liquidity position has to be 9 months of debt service. So those are 2 things to kind of sniff test to get through the Fannie Mae approval process. I would say another example, we talked about how more people are coming into the upstate New York market and recognizing a value purchase. we're seeing that even though we're doing this right now in the Rochester market, we have a California borrower and they're acquiring an upstate New York property, but they have to have a upstate New York management company because it's, again, 48 units, something like that, maybe even only 40 units, but they're not going to be able to successfully and efficiently manage it from California. They want some boots on the ground for leasing, et cetera. But at 40 units, you can't put a body down there and have a salary. You'd have to use and leverage a third-party manager.
We're talking about 9 months of reserve. Now, that is excluding the amount of money required for like the actual down payment and downstroke for a property. So you have to have that in addition to that.
Correct. And they're not going to use that money and collect them. The lender's not going to have access to that money. They just want to be able to verify that you have the wherewithal to get through a little bit of a challenging time if something were to happen. COVID's a perfect example. Nobody was paying their rent at the beginning of COVID until the government stepped in and helped with some of the programs that they did. And we're in New York, which is a very tenant-friendly state, not set up for you as the owner to succeed. So the lenders have to make sure that you are strong enough and have the wherewithal to get through any challenges like another COVID if we ever, God forbid, have something like that happen.
Tom, third to last question. Why does every deal seem to need more equity in the current lending environment?
I'm going to get a little bit technical here, but I'll try and put it down to Tom Grzebinski mentality. We're in a higher interest rate environment over these last 2 years compared to where we were 10 years ago. So interest rates have increased and the valuations, the cap rates have not increased as quickly as the interest rates have increased. So what it's doing is causing chaos on the sales side. The seller thinks he has the Taj Mahal. The buyer thinks it's a piece of junk. And they can't get to the table and come up with a number that's fair for both of them. And so the seller doesn't have to do anything. And the buyer can't do anything unless the seller does something. So you're getting the frozen market in general, this frozen market, because when you look at the economics with a higher interest rate, the cash on cash return goes to a number that's not very attractive today. So if you're buying something at a 6% cap rate, just as an example, multifamily at 6% cap rate, and you're trying to get to your 1.25 debt service coverage, that means you're at a 70% loan to purchase price, which is a 30% equity slug. But when you start doing the math, it's like a 4% cash on cash return today in place. We're not making any assumptions of future rent growth and expense cutting. We're talking about just true economic, day one economic. A 4% cash on cash return, I could take my money and waddle it over to a credit union and get a CD at 5% and have no risk at all. So why would I take that money today unless there is some compelling reason or there's some certainty that that project is going to return more than 5%? And that's why the market's really stifled right now, because the values have stayed higher than what they really intuitively should be based on the fact that interest rates have risen so quickly.
So next question, what are some of the reasons that a loan turns sideways? And maybe this question is, why does it turn sideways in the middle of trying to get it, for instance? Or how does it turn sideways after closing, after the loan has closed?
During the acquisition, it turned sideways because there was not enough transparency. There is something that was found in diligence. Maybe it could have been something like delinquency. And even though the rent roll shows 100% occupancy, you only have 50% of people paying, and they can't kick the people out because the cost to evict is so high. And by the way, when that's happening, those tenants that aren't paying, they're not being respectful of your property. They're kicking the drywall in and they're using the refrigerator doors as sleds or whatever else they want to do. You don't have respect for the property, right? So you know that when they leave, you're putting $10,000 more into that property to get it ready for the next tenant, which means you're losing 6 to 12 months of rent just to get that tenant out of there. So the diligence wasn't forthcoming at the beginning. That's generally the reason that deals don't get to the finish line on the purchase side. There could be things like title or legal type of things, but in general, it's because somebody didn't share all the information the proper way. When the deal is already, the horse is already in the barn and the deal's already done, the lender, sometimes the deal's turned sideways at that point also. And the reason that happens is typically because the properties are over leveraged, and then there's some kind of an adjustment within the market. Either the rent rates are dropping. We're going to use multifamily as an example. You can't fill a space. It's a smaller size deal, 10-unit deal, and you can't fill 2 of the units for 3 months. Well, I mean, that's all the cream for you for the year is those 3 months of those two units or something like that, just as an example. So then you start, or there's new competition is the other one. New competition sometimes creates a lot of chaos because intuitively you're buying something and you think you're going to push the rents, and all of a sudden there's a brand new pretty pony down the street that's coming online 6 months later, and everyone's going to spend an extra $200 to go to the new units, and you're going to have to push your rent down instead of up. And there's not going to be a rent appreciation in that case.
So Tom, transparency was a big reason. Let's talk about that. I mean, what are some examples of maybe some horror stories that have happened in deals that you've done where there was things that should have been made transparent that weren't, and also if they were made transparent, there would have been a way to actually work around it. Can you give me a story about that?
I think for a couple of drinks, I could get some better stories for you also. One example would be a story where the vacancy rate was 10%, and the buyer was like, oh, this is great. We're going to have some upside on this deal. We're going to buy with in-place incomes, and we'll have that 10% increase. Well, when we walked through the property, the units that were vacant weren't rentable units. They were bastardized units. They were taking the fridges out and the stoves out and using it. They were taking cabinets out. So they were just stripping out those units. They're just not usable units. So that pretty much put a pause on that type of deal. Just surprises like that. I want to just take one more step back, and things that turn the deal sideways after the loan's already closed. If we could just go back for one more second on that. In upstate New York, taxes are becoming a bigger and bigger problem. Every municipality was living off of the state, the local municipality, living off the state, which was feeding down the federal dollars that were getting us through COVID. Well, those dollars are no longer there, but it's like crack cocaine. These local municipalities can't stop spending the money. So their budget was $20 million before COVID. It was $25 million during COVID because they got $5 million of enhancement. Now COVID is gone, and their budget's going to be $26 million because they're not going to cut any programming, et cetera. Well, that money still needs to get filled, and it's going to get pushed onto the landlord. And so you're seeing material increases. Every assessor is pushing their valuations right now for assessed values. Well, that's a real issue for you if you're a multifamily individual and your taxes just went up $500 a unit, and you push that down to your residents by increasing it more than $50. That'd be like a $50 increase a month, right? If it raises $1,000 a unit, there's no way in upstate New York that you're going to be able to push your rent $100 a unit to offset that. The second thing that's also happening outside of taxes right now is insurance. Insurance costs are becoming a real challenge. For the majority of my career, insurance was always $250 to $300 a unit. That was kind of an underwriting standard number. That number is now pushed up to $400 to $450 a unit just for vanilla. And then if you ever had some kind of a claim or something, you could go push it further than that, $500 to $550. Still a reasonable number when you compare it to the Floridas of the world, but it's a material number from an underwriting perspective. If you bring a deal in, whatever your insurance number is, just assume it's going to have a 10 to 15% increase over the next year.
Why is that? I mean, I get Florida and Texas and California wildfires and that sort of thing, but this is affecting us in Western New York as well. Like, why?
Well, because the Florida operation of National Insurance Company X went bankrupt, and so they have to make their money somewhere. They're going to make it where they can in upstate New York or New York State. I mean, New York City is getting the same problem that we are. The whole state's getting crushed.
Yeah, absolutely. I mean, that's really, really important too, in terms of like every time when I'm doing a preliminary underwriting on a deal, even before we make a offer or a letter of intent, is I have a great commercial insurance agent that I'll run the deal by give me a quote on this so I can apply it to my underwriting. And that's definitely saved me, for one, a lot of credibility, for instance, because the worst thing you can do is using numbers you were familiar with a couple of years ago and then making an offer, and then realizing the insurance costs are higher, and then now you're having to retrade a deal mid-contract, which is the ultimate credibility burner with commercial real estate brokers too, because it shows that you don't know what you're doing.
Outside of having the best commercial real estate broker available in the market, I think every borrower, every owner should also have the real estate attorney, the accountant, and the insurance agent. Those are the three folks that'll really help navigate a successful owner of a real estate property.
Last question, Tom, before I stop interrogating you here. How should the borrower and lender react to a troubled loan?
Don't bury your head in the sand. If you have something that's going on, your banker is an advocate for you. Communicate with them, over-communicate with them. If you hide something and it'll figure itself out, likely it's not going to figure itself out. And now your banker can't go to bat for you within credit because it's a surprise to everybody in the bank. If there's an issue, bring it up, communicate with them, and work through it together. These banks, especially your banker's not trying to put the screws to you. He's trying to be an advocate. He or she wants to do more deals with you. So the more that they know, the better off it is for you. When the banker sends a request for annual financial statements or personal financial statements, etc., comply to that request. You've really got nothing to hide. Do the work. I mean, you signed the loan documents that said that you were going to do it. Do it. I mean, if you don't do it, you're in technical default. I mean, that's the last place you want to be. But if a deal is going badly, or a tenant's going up, the tenant goes away and you can't backfill space, etc., and you're struggling, tell the lender sooner than later.
No, absolutely. All right. That being said, we're going to wrap up today, Tom. And in the next third installment, today we're talking about focusing on the lenders and the type of asset class types. In part number 3, we're going to be focusing on the borrower, like who is an ideal borrower, realistically, who is a qualified borrower, what types of properties should first-time investors be seeking when they're looking to swim upstream, and all that good stuff. You're not going to want to miss it, and we're going to be doing that next week once Tom and I coordinate our schedules together. But in the meantime, definitely reach out to myself or Tom if you have any questions at all associated with commercial real estate, especially commercial real estate, to Tom Grzebinski here of Gantry. And again, Tom, thank you so much for your time today. I appreciate you provided a ton of value.
Matt, I'm going to leave you with one request. I need the name and the address of your barber because I still need to get my hair cut. Maybe by the 3rd session, I'll get it done. But at this point, I think I'm just going to let it flow.
All right. I'll send the link to you. Yeah. Trevor Lake over at the Style Council on 9 Canal Street. Shout out to Trevor. All right. Thanks, Tom. I appreciate it, man. We'll see you next week.